Alright, welcome to the CFO channel. My name is Ali and I simplify accounting and finance concepts. Now, if you're the founder of a startup, there reaches a point in your journey where you decide that you have to raise money from investors. In this video, I'm going to give you some reasons why you shouldn't raise money. Now, before we get into this, let me say this. I'm not saying that raising money from investors is completely wrong. Rather, it can be quite useful for a lot of businesses out there. However, what I've seen in the current environment is that a lot of founders raise money for very frivolous reasons. Number one, they'll raise money just because they can. Number two, they'll raise money just to get some press coverage. And number three, a whole host of other nonsensical reasons. Okay, so let's get into it. Here are 4 reasons why you shouldn't raise money from investors. Number one, control. Once you've raised money from investors, you as a founder need to understand one thing. You are no longer in control. Once you raise that money from investors, you could have gone from being the sole shareholder or sole owner of your company to now becoming 50-50 partners with your investors. So that means your 100% stake in your business would have been diluted or decreased from 100% to 50%, and then your investors would also own 50%, so that way you become equal partners. In other cases, you could have raised money where your ownership of the business actually starts at 100% and then drops below 50%. This would mean that your investors own more of your company than you do. And here's the thing you need to keep in mind. Once you have a new owner in the business, they will want to come in and assert their control and their wishes on the business. They will want to drive that business to a future state that is most desirable to them. And there, ladies and gentlemen, is our first point of conflict. Your investors' desired future state for the business might be very different than your desired future state for your business. What do I mean by this? This means that you have different goals and objectives vis-a-vis your investors. Let's say you'd be quite happy to build your company to become the size where it's producing $10 million in annual revenue per year. But your investors, they don't want $10 million. They want a company where they can make $1 billion. Usually investors are looking for a large exit via some acquisition of some sort or an IPO. Reason number 2, a misalignment of time horizons. A good majority of investors are looking to earn a rate of return on their investment. This is no surprise. They're in the business of making money after all. The quicker they can make this return, the better it is for them. Let me explain this by using numbers. Let's say they invested $100 in a particular startup. 10 years down the road, that $100 could double to become $200. Now that's option A. Now let's say you have a second option where you could invest $100 and that $100 could double to $200 in 5 years. So not taking 10 years in option 1, but only taking 5 years. How do you do this? Well, you would do this by using a number of strategies. For example, number 1, by having a low price for your product, by pursuing customer acquisition quite aggressively, and likely for a lot of businesses, running losses so they can basically capture the market that you're trying to go after. A lot of investors would convince you, the founder, to choose option number 2. This is the option where you're running losses in your business in order to capture the market quickly, such that you're able to grow the value of your company, and in return, the investment that the investor has made in your company also grows in lockstep. I would call this approach the growth at all costs approach. Now, once their investment doubles or increases in value and there has been a certain passage of time, a lot of investors would be looking for something called a liquidity event. What does this mean? This means that the investor wants to take the money out of your business and their associated return. This is usually done in 2 ways. Your business either has to be acquired by another company, or your business has to go through an IPO. Now here is where that misalignment of time horizons comes in. You might not want to run losses in your business. You might not want to reduce the price of your product to the floor in order to just acquire customers in your business. But you might have to do that because your investors would tell you, or your board would tell you, to do that in order to maximize the value of the company. Reason number 3, you're not their only investment. From an investor's perspective, your startup is one of the many investments that they've made. And venture capitalists, these are investors that invest in startups, know that a lot of their investments might not work out. So they may invest in a particular company and lose all of their money because startups have a high failure rate. So from the VC's perspective, if your company is not doing well, it requires a lot to convince them to give you more money in order to be able to keep iterating and trying to make your company a success. The investor would really have to buy into the long-term vision of the company. Let me ask you this from an investor's perspective. Would you put more money in a company that is losing money? Probably not. You would want to take your money and put it in your winners. You would want to put it in companies that are quite certain of achieving some sort of a liquidity event like an IPO or an acquisition of some sort. Now, this creates a natural conflict in how an investor looks at your company and how you look at your company. To you, the founder, your company is quite special. It's your baby. You've put your heart and soul into it. To an investor, you're just one of many companies that they've invested in. You're nothing special. And then when push comes to shove and hard times come, your investors might not be so inclined to give you more money to help you in your time of need. This is because, quite rationally, they would rather only lose the initial investment they've made in your company rather than putting more money in and risk losing that too. And point number 4 is decreased risk tolerance and agility. Once you've raised money, you have a responsibility to your investors. You've taken their money and they expect you to solve a particular problem or go after a certain market. Therefore, if you all of a sudden need to make a big change in strategy or pivot or go after another large market that you didn't see before and that seems quite uncertain until you try it and test it, you now have another owner, an investor in this case, to whom you need to go to get their approval before you make a change in strategic direction. Typically, a lot of investors would appoint a board on your company. If the company was to make a big change, or at least undertake a huge change in strategic direction, this would sometimes, or in many times, require board approval from your investors and from the founders of the company. And here's the reality. You as the founder might think that a change in strategy is a really good idea, but your board and your investors might disagree with you. One of the biggest advantages that a startup can have is that it is able to move quickly, be agile, and be able to pivot on a dime. Once you raise money from investors and you have a board, there's quite a bit of red tape in that, so it's hard to be more agile and flexible. Now, finally, as a real-world example of what happens in tough situations between a founder and an investor, we'll cover the story of a company called Renault Run. Renault Run is a company based in Montreal, Canada. In 2022, they had raised over $120 million. They were on top of the world. They were crushing it. However, in 2023, just a year after, they had to lay off all of their employees and declare bankruptcy. The company did a complete 180. Now, if you look at the story quite closely here, the founder actually tried to raise more money towards the end before declaring bankruptcy from its existing investors. However, what happened in this case is that one of the major investors walked away and the founder couldn't make it happen. In fact, towards the end, when the company was desperate to survive, it did whatever it could. It laid off employees, it cut costs, they were trying to raise more financing. While they were doing this, one of the investors on the board actually had the audacity to say that, hey, for all of your employees that you've laid off, don't pay them severance. And that, ladies and gentlemen, is a cautionary tale indeed. Sometimes the investors on whom you relied on to provide capital will not be there in your time of need. So I hope you got some value out of this video and learned some reasons why you shouldn't always have to raise money. If you like this video, give it a thumbs up and check out my previous video here where I talk about the difference between profit and cash flow. See you in the next one.